Welcome to another episode of the And Asset Show. All right, this is our fourth time trying to record this episode because of technical difficulties. We thought it had to do with a limit issue on how much content we recorded, and Riverside said, nope, you got to upgrade your plan to be unlimited. And what we come to find out is that it's just a Riverside issue. So we are starting over, starting from scratch, doing it for the fourth time. And I'm going to make the same lame joke for the fourth time in a row.
I'm still going to laugh because it's still going to be funny.
Amazing. All right. So some of you guys have been wondering, where is Caleb Williams at? Well, Caleb is being super intentional with his family, and he decided to opt out for this week. And it's funny, Caleb calls me Dominic Rufran, and we've known and been friends for 7-8 years at this point. And it's Dominic Rufran. And so Caleb Williams with a W is not here, which I know he gets flack all the time with his last name, just as I do. And also, we have Mr. Demetrius Walker, head of sales, one of our top wealth coaches, to replace Caleb this week. Caleb will be back, but we're going to have still an amazing conversation regardless. So Demetrius, aka Demarius, I'm just butchering everybody's name at this point in time because that's what we do. Thank you for being here, sir.
Yeah, of course, man. It's a pleasure to be here. I'm excited. And you guys will be surprised how many times Demetrius has been called Demarius in the last, 5 years, well over a dozen times. And also how many times Caleb Williams has been called Caleb Gilliams. Who knows?
Luckily for Austin,
Pronunciation.
You got one of the most basic names ever.
Most
so
basic white guy names ever. Yeah, there's like Austin and Lance, and that's pretty much like as basic as it gets.
Amazing. All right, just because of time, usually you guys get a full hour and a half with us. We talk about a lot of different things. As of late, we've been talking about the Infinite Banking Concept book, but today is not that day. And because of our technical difficulties, we are only going to have about 45 or so minutes together. So I know some of you are like, thank goodness, which if that is you, hey, you're welcome. And with all that being said, today we are going to talk about the most sexy thing on the planet. My wife. No, I'm just kidding. We are, which is true. But what I was going to say is life insurances, which is what I've always done, what I've always talked about. And so with that being said, today, we are not going to talk about the book. We are going to talk about policy loans, everybody's favorite subject, because that really is what really life insurance overfunded, the concept that we essentially coined the And Asset really is about, is utilization of it while you're alive, not just having it just for the death benefit, which is also a very powerful piece from the legacy perspective. The living benefits, the cash value is something that helps us show up more intentionally. And so with that being said, what we want to do today is, I'm sure there's some of you that are out there that are trying to figure out if you have a policy, do you want a policy? But if specifically, how should I utilize my policy? When should I utilize it? Some examples, different asset classes. And so with that being said, I would love to start with you, Mr. Austin Williams. What in your mind is a couple tangible ways that people should look at and consider taking a policy loan when it comes to using it for these And Assets specifically?
Great question. So figuring out whether or not it's a smart idea to take a policy loan. Obviously, you have to have enough liquidity in order to do so. So do you actually have a big enough cash value in order to do so? And that's obviously the first easiest thing to determine. But secondly is like, is it the smart thing? So maybe you do have enough cash value, but is it a smart thing to do? And what I generally walk people through is that one of the first things to kind of think about is whatever you are wanting to put this money to, you're taking it out of a very safe environment and you are introducing it to a little bit of risk, which is not a bad thing if it's being done for the right reasons. Is that, and then however you are introducing those dollars to risk, is it risk that you have specialized knowledge of or experience in? And if you do, then there is a better chance that that will be a wiser way to introduce risk to your dollars than something that you are totally new and green to. So those are kind of the first two things that I usually walk through with my clients.
Can I touch on that real quick? Because like I've heard, and you guys can push back with this if you want to, but I've even heard like in some cases, if you have a specialized knowledge in something, and not only the specialized knowledge, but also the experience with a particular thing, I'm not going to say it removes your risk. So like I'm agreeing with you, but the slight tangent of a disagreement would be that like the more risk and the more experience you have with something, the less risky it becomes because you've done it before, perhaps. But that's just like food for thought, for quite frankly. But overall, I would say I agree with you with a slight tangent.
I guess I agree with your agreement with me because it feels like we're saying the same thing. Yeah, I don't see a disagreement.
The disagreement was Austin said you're borrowing against your policy and you're putting it into something risky. And I would say that if you are putting money into something that you know really well, the risk is really low, if not gone, if you really know it really well. But Austin, you made it seem like no matter what you put it into outside of a policy, it's going to be risky. And that's just like, it seems very black and white. And it's
okay.
like, it depends on the person.
I guess it is the environment. What I said is going to be more risky than the current environment it is inside the cash value, and invested into whatever the portfolio that the insurance carrier is invested into, which is an incredibly safe, non-volatile portfolio.
Yeah, I guess where I was coming from is like the investor is it's like that's kind of the most important piece outside of just like the investment that you're putting it into. But again, tomato, we're good.
That's right. Maybe Demetrius disagreed with me, but Demetrius, we're speaking the same.
Okay.
Let's go.
You guys woke up together. Trying to match and have the same exact T-shirts because you want to be twins.
I know.
I
noticed that
arguing like you're
like
anyway. Austin, you're arguing with Demetrius like he's your adopted brother or something.
That's right. Yeah, we might argue, but we'll be related. That's right.
Love it. All right, amazing. So, Austin, you talked about the framework. All right, first we discuss: are you educated in the thing you want to borrow for? And then, let's say they have enough liquidity, they're educated. What's kind of the next piece to it?
Yeah. Next step is okay. So you have a specialized knowledge, experience. You have enough cash value. Is whatever you want to invest into going to earn a greater rate of return than whatever the cost to finance the loan is going to be? So as we all know who are talking here, likely you who are listening, is that these loans are not free. There's no such thing as a free lunch. And that's especially true with life insurance, is that if they're going to give you, a loan for the cash value of this policy or whatever amount of the cash value that you want, except it's not for free. There's a finance charge on that loan. And every carrier does that finance charge a little bit differently. Some carriers do a static charge. Some do a charge that is going to be different year to year. But ultimately, there's going to be a cost to finance those dollars. And let's say that's, just to make it really easy, let's say 6%. Is this income producing activity that you're invested into going to have a greater rate of return than the 6% finance charge of the loan? If yes, then it might be a smart decision. If no, probably won't be a good decision unless there's some like very specific reason why you want to do it. So that'd be the next step.
Amazing. Demetrius, do you agree with that framework?
Yes, more or less. Yeah. So I'll tell you what I was thinking about as you were talking, Austin, is like, how quickly are you going to get the return as well? And then like, are you okay not being able to utilize those dollars for something else during that season? And so the way I'm thinking of it is like, whatever you're investing in, is it producing some sort of a smaller amount of cash flow? Or is it that you're taking that full amount and you're going to flip that money pretty quickly? In other words, let's say if someone has $100,000 of a loan, it's like, are they going to be earning 20 grand a year off of that, 20% a year off of that? Or is it going to be they turn that 100 grand into 120 grand within like 1 year or one time frame, right?
Yeah.
And so that's a different way of looking at it. It also changes how you go about paying back the loan over time as well. One takes a little bit more intentionality in I'll call it budgeting, if you will, but neither is right or wrong. It's just that's what came to my mind immediately, because investments are different across the board. And I would say, Tom, you could speak to a lot of the whole like amount of time it can take to get investments back, given your real estate background, couldn't you?
Real estate. I've used policy for crypto. I've used my policy for a few different things now. I've had it for I think seven years at this point in time. So it's it's been fun to be actual utilization of it versus just being a someone who talks about it. And so what I would love to do is one, I'll talk a little bit more about some of that, some of the things I've used it for, how I've used it. But I'd love to just list off a couple different assets, and then on a scale of 1 to 10, you decide the game you're gonna have to play. What would you rate of like 10 borrow for sure, 1 would not borrow at all for it, and let's just say maybe try to think maybe universal, okay? Because I know that you guys specifically will be different than like try to give most people that are listening a framework of like, oh, that's a decent idea or not a decent idea, and then we'll start talking about some examples of maybe some of these asset classes, or maybe get into specific real life scenarios that can give maybe a better framework. So right now it's going to be somewhat black and white, because there's always going to be some gray as we are asking clients questions and we start asking people questions, but we'll just go ahead and start there. So we're going to start, and you each will go Demetrius, Austin, Demetrius, Austin. So Demetrius, you're going to likely always go first. So Austin, try not to be too influenced. All right. On a scale of 1 to 10, 10 is like 100% would use it for it. Right. And if you want to give a 1-line justification, 1 to 2 at most, okay, don't go on a crazy, put the fries in the bag in this example, right? we got to make it crispy, make it clean, right? Tell me maybe why, okay, you would give it the rating that you did as well, okay? So we're going to start with everybody's favorite topic, real estate. Demetrius.
I'm gonna go 5 on that one. This is personally, and I'm gonna say this just because of my personal knowledgeability of investing in real estate, and knowing that it's one of those like super quote unquote sexy investments that everybody wants to get into, but not enough people know enough about. And so that's why I would say that. Short
All
justification. Right. There's so much more I want to say, but
amazing. Austin, we'll come back to that.
I'm going to. I'll even undercut Demetrius. I'd say I'd personally put myself at a 3 or 4, because I just don't know enough to be dangerous when it comes to real estate. I know that real estate has made more millionaires, or at least that's what's been repeated around. I haven't done research to that effect, but it's made more millionaires than any sort of other asset class kind of in history. So it's obviously a very valuable thing. And I think there's a majority of the people, I would even say, who do utilize policy loans that are our clients are going to do so in service of getting like enlarging their real estate portfolio and being able to do that. But personally, I just don't know enough about it. And I could even say is that, sometimes, maybe most times in recent history. Oh, actually, you know what? I'm going to stop because you asked one line and I went,
appreciate you putting the fries in the bag.
Let's
I appreciate you. People are like, all right, I want to hear the next class. I want to hear what
you said it, bro.
Are. Yeah.
Yeah. All right. The stock market.
1. they're so separate. And unless you are an incredible options trader and that's just the background that you have and you're studied up, you're probably going to be in a worse off position potentially.
Yeah, I would even go lower than Demetrius. Oh, no, I can't go lower. I'm going to say 1 too, because ultimately, if I really wanted to have this extra level of risk, because ultimately, when you invest in stocks, you have extra risk, and if I wanted extra risk, I'd have an IUL, and I personally would not want to have an IUL. So why would I introduce my cash value to that kind of volatility inside a whole life product?
This is tough, Dom, because it's like we got to be quick with the reason, and at the same time, just like Austin, I'm inclined to want to give more like background to what I'm saying, but it is what it is. Like, let's play the game.
We got 34 minutes.
I plan on winning.
Winning. I didn't know there was like a game like with a prize at the end. All right. Let's go bonds.
1. Well, hold on. Depending on the yield you're getting, I'm gonna say 2, and I'm actually not even gonna give justification for that unless you really want me to give one.
No, I have so many questions now after hearing your guys' numbers, so this is great. Austin.
I would also do a 1 for bonds, just because why would I as an individual get bonds? And this is a great plug for us to link to the video we just posted with Tom Wall, who just gave a great breakdown on why whole life is such an attractive way, an attractive savings tool. in comparisons to bonds is that why would I as an individual invest in bonds when I can't even get the prices that that the carrier gets different prices on bonds than I can as an individual, and they hold bonds all the way to the point of maturity, right? So it wouldn't make any sense for me to personally invest in bonds when I could have somebody who does it way better than me and has that as their whole portfolio do it, or a large part of the portfolio.
And I have to throw this out there. Most people who are watching this, if they're going to be investing in bonds, normally we're thinking bond funds. And I think people kind of conflate just an individual bond versus a bond fund, which they're not necessarily one and the same.
Yep. And I also want to remember, we're not talking about or, we're talking about and, when you would borrow against to put it into the thing, right? So I just want to make sure we're super aligned. All right. So we got that. Let's talk about a credit card.
Hey, it's Demetrius. Just want to pause the video real quick and let you know about our education hub that we call The Vault, because the reality is most people have no idea how to evaluate whole life insurance. And so The Vault is a collection of all of our best resources and educational tools to help break it all down. So there's a calculator, a handbook, a crash course, a deep dive videos on all of the numbers. You have all of that in one place and all for free. So go ahead and click the link in the description or the tag comment below to unlock your access to The Vault. Now back to the video.
I'm going to say if you have the liquidity already anyway, and for whatever reason you're in debt, I'm going to go up to like an 8 because you're exchanging a higher interest rate for a lower interest rate, but then you have to incorporate the discipline to then create new habits.
Mm-hmm. Yeah. I would, if I had put my family in a position of getting, massive credit card debt that has, 20%, interest rate on it, 6% is way better than 20%. I mean, that's just arbitrage. That's just a no-brainer. So that's like a 10 out of 10 for me. Obviously, I would never want to put my family in that situation. But just getting a better interest rate is good. However, like Demetrius said, you have to come up with some better routines and just some better money managing skills that you don't get back into that hole again.
Amazing. We got 2 more and then we'll wrap it up. A vacation.
Ooh, I'm actually going to say like a 7 on this one because depending on what the vacation is, I'm not going to say what the vacation is for, but it's all about what you value when it comes to something like a vacation. Like, is that vacation going to put dollars right back in your pocket? Probably not. And at the same time, if you care about the compounding of dollars, even when you utilize those dollars, I mean, why not utilize a policy loan for that too? Also depends on the season of life, but I'm going to stop there because I'm not going to specify.
I'm going to pick it up right where Demetrius left off, because where I was going with that. So right now in this season of life, when I'm in the accumulation phase, thinking about, retirement planning, some people have different, opinions on that, on whether you should retire or not. But in an accumulation phase, it would be very low, like a 2 or a 3, because ultimately that compound interest will grow if I do not end up paying that off. And now if I'm wait later and I'm in the kind of the distribution phase of my retirement planning, and it's just a lifestyle choice, and I just want to make memories with my family and my kids and my grandkids, it'd be like a 7 or 8 or 7 or an 8, because once again, now this is the point when I'm not so worried about the compound interest, because I'm more focused on using the policy and what I've accrued so far for the living benefits.
Amazing. Okay, last. Actually, I have to say this one because everybody wants to know, and then I'll do the last one. Is a car.
I'm gonna go. Let's just go a 6 for that one, just because of like, you could. No, I'm actually gonna go 8, just because of the fact that if you have more, if you have the liquidity within your policy anyway, you can probably get better terms by paying for the car in cash and then paying that policy loan back over time. I think that's just a more efficient way to do it in many instances, not every case.
Yeah. With fear of offending some of the Nelson Nash purists out there, I would say like a 3 or a 4, just because when I bought our car about, was that 4 years ago now, the rates were, I think it was 4.75%. And personally, there's a one way to look at infinite banking where I should have still taken a policy loan, and then I should have still charged myself, the above whatever the cost of the policy loan was, above what the cost of that I took to finance the car through the just through the bank. That I should have done that and added that back to my personal bank. So I get it, I understand, but personally at the time it was just good to get the lowest rate possible. So I opted just to get the lower rate rather than using it to finance it through a policy.
Amazing. All right, last one. Business.
Oh my gosh.
Hmm.
I'm going to say a 9 on this one. It's hard for me to give anything a 10, but I'm going to say a 9 because for the right person, if you're getting into business, that probably means you understand the product or service you do pretty well. So then it's just a matter of hiring the right people or learning marketing well enough in order to get in front of the right people. So you can recoup those costs and profit in a more reasonable fashion than maybe some other more speculative investments, which again, business can be speculative in and of itself, but you're investing in yourself, investing in your future and other people that you're serving.
I'd say this one aligns much more closely with like the kind of value that I want to add to the world. Is that like with some of the other asset classes you mentioned, Demetrius, is like, especially with stocks, it's like, you know, if you do calls or whatnot, and you like, are you actually adding value to anything, or are you just betting against something, right? Like if we're talking about a business that you like their mission, you like what they want to add to the world, and you just want to support that, I love it. So like that's like a 10 out of 10 for me. If I find a business that I want to support, that I see they have strong financials, they like what they're doing, that I want to support, like that'd be like a 10 out of 10 for me, because I want to actually add value to my community and to the world at large.
I feel like this was a personality assessment, Dom. Like you did this on purpose to see what we would say as our personality. I don't know. So anyways, you go forth.
No, so to me, it sounds like, Austin, if I had to recap, you wouldn't put your money in anything from borrowing against for majority of scenarios except business. Like everything you gave was pretty low unless you had like high credit card debt.
Yeah. Or unless I was in the distribution phase of retirement planning for a vacation, then it'd be like, okay, yeah, like that makes sense.
And Demetrius, it sounds like for you, a lot of it came down to, it depends for a lot of the scenarios.
Yeah,
majority of it.
works. Yes, for sure.
Amazing. Okay, so what I think this did a good job of showing everybody is that there is no one black or white answer for should you or should you not take a policy loan. I think the framework that we came up with to be able to justify mathematically should you or should you not is what Austin said at the beginning. Should you borrow from your life insurance policy, make sure that it's greater on the other end of that. And both of you mentioned when it comes to the credit card debts, like the credit card's usually higher. So that's a great example of I'm instantly getting that back to my quote unquote household economy by paying that off, so on and so forth. Now, that's the great part about if you work with us and you work with somebody who actually understands this concept is if you get a policy loan and you get a policy in general, we can sit down and ask you the questions. Yeah. What do you want out of life? What are you trying to accomplish? Where are you trying to go? Because like Austin said, depending on his season of life, if he's later on in retirement, if he's not, he may change it up just slightly, right? And so from knowing this, what is the thing that you guys have that is so much more greater in business? Like why specifically in business is that so much more attractive to you guys? Knowing that in theory, it's not your guys' even main source of income at this point in time, right? Giving it a 10 or a 9, right? But some people's full-time business is real estate. And you guys gave it a 3 and a 5. So I would want to hear the justification around the low numbers of real estate and the high numbers over there, and maybe think personally and universally, because, you know, I'm a huge, like if I were to have given this, I would have not given it a 3 or 5 personally for real estate. I would have given it a lot higher, like 8 or 9 probably. So I'm more curious on that end of like, why did you guys give it so low outside of maybe you guys aren't skilled in it relative to maybe what some other people are. And maybe that is the justification. But, you know, I tried to say at the beginning to frame it of how do we attack this from the most amount of people that are hearing it at the same time?
Yeah, I mean, universally speaking, I think a lot of people want like a quick buck. And, you know, it's not like trying to, you know, be rude to the masses, if you will. But you just hear a lot of stories that end up bad or end up just like in a sad ending from a standpoint of, I thought it was going to produce XYZ. Like I know a client, incredibly sweet gal, who got into a real estate deal. It was supposed to pay out 2 years ago, still has not paid out, and probably heading towards like a class action lawsuit. And it's not that like things like that, some people are in the camp of, you know what, that's never going to happen to me. I'm going to do my homework, which is, I mean, that's great. And some people are in the camp of, I'm never going to get into real estate whatsoever because that's going to happen to me. And so that's kind of like the two ends of the spectrum with how I see it. But I think it's hard.
What's the difference in your mind for somebody like that
Yeah.
versus in business? Somebody starts a business, they do it for a year, and then it flops and everything goes under, and they use their money for a business.
Yeah. There's more control typically that people have if they start a business than if they put money into a particular real estate deal. But I guess it depends on what type of real estate you're investing in. Because I would say the one that's probably the most risky, because you can't really understand it that well unless you know how to understand it, you know, the right questions to ask, would be things like syndications. I think they're like the sickest type of real estate deal out there if you get into the right one. But when it comes to, you know, flips and all that, maybe I'd give that a higher number if you have the liquidity, simply because you can go get the raw materials to go flip a house and it's right there in front of you. But if your syndication is 1,000 miles away, that could be a little harder.
So the idea of a syndication is you give your money to an expert. If you're starting a fix and flip business, you're starting with control, but you're not the expert. So you're actually beginning conversation, creating more risk based off of actual understanding of the actual investment. So to me, doing fix and flip is actually more risky than it would be if you gave your money to a syndicator who actually was skillful in what they do.
Yeah, I agree with you. And it goes back to the point from earlier of like, did you know how to do the due diligence? Because if you know how to do the due diligence to know how legit is this person who's the real estate expert, then you're probably in good company. But if you're just like, you know, I gave my money to this person, I think they're gonna flip the money some way somehow, but you're like, I have no idea their background, I don't know what they've done in the past, I don't know how they're qualified for this, then they could be there. I don't know, I hate to use the word, but like scamming you. And that happens in the world, as much as I hate to say it. So it just boils down to the due diligence at the front end.
Okay, so if somebody does their due diligence, really vets the person, does a syndication, they don't have control of the outcome in theory, right? Versus you have massive control of the outcome of fix and flip, right? But you're just starting. Now, which is better?
So you're saying you got control with the fix and flip versus you got the right person with the syndication. I'll probably rank it the same. I'd probably say like 7 or 8 if that were the case. Just because. So because because with the fix and flip, you still like you still have to do your due diligence there too, right?
Yeah.
What type of house are you getting? Is the foundation slip like kind of falling under from beneath you? Like what are you being conservative with your estimations, right? Or are you kind of seeing things through rose-colored glasses, right? How realistic are you being? So I'm saying that as if I'm a real estate investor, and I'm not, but I've heard enough stories, you know. I've been around enough people who are, you know.
Amazing. I think what Demetrius is saying, for every one story you hear of like the get rich, there's also the other 10 of the people that fall and go under that essentially fail, right? And we've heard of a lot of people that are in Ponzi schemes or people that give a ton of money, lose it all. And it comes down to I think the framework that Austin and Demetrius are talking about of risk when we're looking at should you take a policy loan or not, because we have seen people put money into a policy, borrow everything. The investment goes under. Now you have a max policy loan on your life insurance policy, and you're in a worse position than you would have been if you never started the policy in the first place, right? So I do think that there is that piece of it that is important to factor as we're looking, should you or should you not take a policy loan for it. Austin, do you agree with the things that, or anything that you'd want to add? If not, like that's like profound. If not, I want to pivot and ask a different question.
Maybe one last low-key profound thing that I wanted to add to that is that I think when it comes to real estate, you know, there are people in 2007 that were doing all the right things in real estate, and then in 2008, even though they were still doing all the right things, they were left holding a bunch of notes that the banks came asking for, and they went under. So the overall environment, I think also the financial environment that we're wading into also really matters. Is that right now, just personally seeing some of the things that I've seen that have been happening at a national level when it comes to politics and the economy, it makes me a little bit more hesitant to want to get into something and introduce a lot more risk to my money. So If you feel confident, though, that you've been through storms like this and that you feel confident in your real estate abilities that you could weather it, then great. But I also think you need to kind of take into account the overall financial environment and whether it'd be smarter to put it all into real estate or maybe put it all into a different asset class.
But you could probably argue that the people didn't actually do the due diligence, even if they were quote unquote doing the right things back in 2008, if they were buying a junk loan that was essentially could balloon at any point in time, which essentially did. And then people's cash flow was way higher from an expense than they could actually afford to keep the real
easy
estate.
mode back then, on easy mode.
So the overall thing that we're getting at in my mind when it comes to investing is actually based off of fear and greed. And I think those are the human emotions that actually screw people over in a lot of ways, versus having a very unemotional attachment to the thing that they're looking at and looking at it objectively based off of the numbers, the experience, the people they're working with, and identifying, is this a good thing to do or not? And the due diligence that Demetrius was talking about is probably the one of the most important things to making sure that you're making a good decision on should you or should you not borrow to be able to do for an activity outside of your life insurance policy. Would you guys agree with that?
I agree with that, and I'll even add a little bit of a piece here. It's like, people from a psychology perspective, they do make decisions. We do make decisions emotionally first, and then we potentially justify with logic. And I think to separate yourself even from that and just acknowledging that that's how you typically make decisions, try it with stuff like this. I mean, perhaps go straight to the logical if it's possible, and take your emotions out of it. Perhaps.
Amazing. All right. Well, what if I'm somebody like, let's just say myself, who really loves crypto? I have liquidity. I really want to invest into crypto. Like I just really want to. And I don't have a policy in theory, right? And I'm coming to you guys and say, hey, should I get a life insurance policy or not? You're telling me that I'm gonna put crypto in the stock bucket because you guys gave it a ones, right? So because of that, are you saying that now I should no longer get a policy because I should not put my money, in theory, borrow against to put it into something like crypto, and I should just take my money and put it in crypto and not get a policy then? Is that kind of what I'm hearing you guys say based off of rating it ones for both of you?
That's not. Go ahead, Austin. I thought you were gonna say something.
Slide. Well, I've had plenty of people I've talked to that are really, really cozy and up to the idea of crypto, and they love that as an asset class. And what I would generally work with them is that I think that life insurance is a great complement to crypto, because once again, life insurance is this anti-volatile asset that behaves very predictably and consistently, and crypto is this relatively unproven asset that has had some amazing gains ever since 2008 or so, whenever whenever Bitcoin kind of first entered the scene. But we only really have 17 years worth of data, and that's a pretty new asset class as far as asset classes go. So I think it's a great complement. Now, do you want to actually take your life insurance policy and use it to invest in Bitcoin? If you consider yourself a crypto expert, which at this point, crypto experts are kind of like, I guess if you call yourself a crypto expert, you are, because it's so new. But you're introducing a lot of risk to a product that is not risky. And to say that there is no risk, or that you are totally confident in it, like, it takes a little bit of hubris, I think, to do that, because ultimately nobody knows where crypto is going. And it's been good so far. We don't know where it is in the future. So, I think it'd be great as a complementary place to put your money to life insurance. But as far as using the policy to invest in crypto, that's making a not risky product a lot more risky. And I don't know if that would actually line up with what the client wants.
Makes the product risky just because you borrowed against it and put it into something that is risky. Like if life insurance is not risky, as you say, and I agree with you, how does borrowing against it and putting it into something risky make the product life insurance risky?
Yeah, because if you want the life, like, and this is what I lead people through, and I make sure every single call that I come to, I've underlined, like with like bold underlines many times, is like the purpose of life insurance, first and foremost, is to put the correct value on your life. Like, you have to come to grips with the fact that when you get a life insurance product, like, you're not just getting the liquid savings tool that you can borrow against, like, you're getting this way, and you're putting this value on your life that's going to take care of the people or organizations that you love if you are no longer here to support them. And that is going to be more difficult or is going to be less assured if you put your cash value and borrow against it and put it into something that's unproven and that we don't really know what's going to do with. Is that you might be doing well on the investment side of things, but the original purpose that what life insurance exists to do is a little bit less certain now. And I want people to know is that, like, if you come and you want to get life insurance, is like you have to realize the value inherent in your life and the need to make sure to cover as much risk related to that for as long as possible for the people or organizations.
Austin, wouldn't you say, though, that business is the same uncertainty that the asset class that we're talking about is? Because 90% of businesses fail in the first 5 years. We don't know if Better Wealth is going to sustain itself. Like, that's the exciting part about business, is you move towards a mission and you collectively work together to something that you have no idea if it's going to work out or not. And a lot of the times for most people, it doesn't.
Mm-hmm. Yeah. And I think this circles back to, like, how do you want to add value into the world? Like, if you are totally content with, I'm making my money like from crypto and I'm doing, calls on stocks and whatnot and everything, like, and that's the way that you want to add value to the world, then that aligns with your values. But if you want to add value to the world in a way where, you're investing in a person or a business, and yes, maybe it has, maybe the returns won't be as great, but you feel like you're actually adding something to the world, I think that psychological benefit is kind of worth the difference.
Dom, can I ask you a question?
Of course.
We were talking about real estate for a while, and we narrowed it down to the framework of the due diligence. What makes, like, when you ask the question about crypto, or we pivoted over to stocks, or we pivoted over to whatever business, what makes the question any different? Like, why would the framework change in your mind depending on the investment when you look at it from a universal standpoint, through a universal lens?
No. I think that it's exactly the same, of starting with the end in mind, what you want out of life, then identifying your skill set, identifying where's the least amount of risk for the most amount of gain, and then deploying that with somewhat certainty that the outcome that you plan for yourself is going to get you to the goal that you want. And that every asset class is going to be different, just like whole life and IUL and VUL will be different. Right. And so there's not one right answer for anybody, but the framework and idea around it, I think, is pretty universally sound if you follow it to the T.
Yeah, 100%.
If you're a high income earner or own a successful business, you're already creating real value in the world. The real question is, are you keeping that money, protecting it, and growing it the way that actually supports your long-term goals? At Better Wealth, we help people like you better keep, protect, and grow their wealth through various tax strategies, estate planning, specially designed life insurance, retirement planning, and even a fractional family office service. If you're interested in one or more of the areas we can serve and want to learn more, the next step is to book a free clarity call with us. Click the link in the description or tag comment below to get started. Back to the video.
All right, we got 10 minutes or so. Okay, so what I'll just say about the whole stock market and crypto and real estate, outside of the framework, right? I think when people are looking at the idea of taking a policy loan and they're deciding what they should use it for, I think that there is tremendous value in the opportunity of just having liquidity for quote unquote a day that may present itself. And what I mean by that is there are going to be incredible opportunities if you have money, if you have liquidity, that'll just naturally show up. And I think that even in the infinite banking concept, the book we're talking about, it says the one who has capital, amazingly, opportunities just present themselves. And I believe that if you actually had money sitting on the side in 2008, buying real estate or buying a stock that you knew was on massive discount that you then purchased to then let appreciate and then resell at a future date, it would have been absolutely phenomenal. And that's what most people do the opposite. They're buying when everybody else is emotionally in greed mode. So like when crypto was up and it's soaring, people then start talking about it and they talk it to their friends. And so they get into it and they buy at the peak, right? Because they're just emotionally like, I'm going to miss out. I'm going to just gain so much. I'm going to 1000x. It's the same thing back then in 2008. Everybody's buying real estate. Loans are easy. It's just like, it's the greatest, sexiest thing on the thing to buy. So everybody's doing it. But likely when everybody's doing it and majority of the masses are doing that thing is when you're getting into the largest bubble, regardless of the asset class.
Sure.
But that's why Warren Buffett, he chooses when most people are greedy for him to get fearful and for him to then go in cash and for him to wait. And then when he can wait and he can present another opportunity that becomes 60, 70, 80% on discount, because that's what happens is some of these proven businesses that have been around for a long period of time will go on discount 70, 80%. Proven asset class, real estate, will go on for 70, 60% on short sales, etc. Buy them up, appreciate, creates massive wealth and massive opportunity. And that's where I think the due diligence, that's why I think the expertise, the skill set comes in. Because if you're trying to do a fix and flip in an environment where interest rates are high, asset prices are high, it doesn't matter how skillful you are, you probably aren't going to be able to find a great opportunity by just forcing yourself to go take advantage and force yourself to go take an opportunity just because you're like, I have money. So the wealthiest individuals, they actually create emotional intelligence. They have wisdom, they have stoicism, and they know when to take advantage. I've heard you, Austin, and I've heard Caleb say this many times as well. And I could get on board to some degree that you say investing in a business creates a ton of value and like that's where you want to invest your money. Great. I always think that we should invest our money where our heart's at and our values at, so on and so forth. The money that you make, right, if you're making from option stocks, you can create income to go then put it into other things you value. So we could just surely look at that from a difference in where do I put my money and just increasing economic value to then go create more value in other places, so on and so forth. There are plenty of people that do a business that it's just fraud. There's plenty of people that do business that it has no true value to it and doesn't actually create real opportunity at the end of the day. They just do it to make a buck. So I don't see it as any different. But I do see, real businesses, real value, putting time and energy into that can create real impact as an amazing place that people should put their money into if they truly value that cause. I do, on the other end, believe that option trading, stock market, crypto, whatever it is, Forex trading, if you do it well and you become skillful enough at it and understand it, it is one of the most difficult things on the entire planet to do well and actually make money doing, which creates an amazing human being internally from the things that I talked about of stoicism, knowing oneself, fear, emotional control, and those all things carry over into other places of your life. You develop an amazing character by being able to have self-control. And that's what in Galatians talks about is like the Holy Spirit. It creates peace, it creates kindness, it creates love, but at the very end, self-control. And so by doing those things, if you do them well, betting, right, I actually think it's probabilities as well. You're learning a unique skill set, just like you were in business, that can then eventually create more value from who you are to then more value to the world, more income to yourself to more value than to the world. And so I'm not a huge stickler on just talking about like in the world of life insurance, a lot of times people are like clowning on IUL or VUL or even whole life. I'm not in the camp of clowning on any asset class within life insurance. And I'm still also not in the same bucket of clowning, quote unquote, on any asset class, period. It all comes down to the framework we're talking about is, do you understand it? Can you assess the risk? Do you have the liquidity? Is it the right thing for you and your family? Will it add value to the thing that you're trying to accomplish in life? If the answer is yes, then go for it. So with all that being said, that's the last thing that I wanted to say with a lot of this. We only have 4 minutes left. Is there anything else that you guys want to add before we hop off to the conversation?
Yeah, I'll add something real quick. It's like if we're talking about any form of life insurance, let's just say whole life insurance as an example, and you're wanting to go make investments or whatever, your policy is only as good as your ability to fund the daggone thing, right? Because those dollars would have been going elsewhere, which could have been stacked up in a bank account or whatever. And so they're going into your policy. So there's nothing, I mean, you're getting lots of benefits with life insurance, but like the value you create to then create cash flow, to then put dollars into the policy, those 3 steps right there, I would argue are like so much more important than all the cool stuff that can be done with leverage and borrowing against policies and all of that. Because if the cash flow isn't there to save in the first place, like we can't even have this conversation, right? Or at least like people who can't create value won't be a part of it, if that makes sense.
No, that's good. That actually then is a good question for Austin is, do you think that people that have high interest credit card debt should put their money into a policy and then borrow against and use it for the credit cards? Because that was something that you said that you would use it for. I know people are asking that all the time. Should I do that? Right? We understand that if you have the control and liquidity in the policy already, and then you go spend credit cards, it's probably better to go pay that off. But if you're like starting and you don't have a policy yet, does it make sense to do so?
Great question. The short answer is if this person who has the high interest credit card debt also believes that their life is valuable and they were trying to put the correct value on their life because they have people who depend on them in some way, shape, or form, then it's 2 birds with 1 stone, right? Like that makes sense to that. Why would you just pay off your credit card if you have the liquidity to do so when you could start a policy and put the correct value on your life and pay off your credit card at a lower % interest rate? So if their goals are larger than simply paying down the amount of money that they owe, and they also want to put the right value in their life, then I'd say yes.
Amazing. That's why I love Austin Williams, because he truly puts emphasis on the death benefit and understands the real value behind it. Right. And I actually would be curious if, you talk to Tom Wall and he always talks about it being an amazing bond alternative. Would it still be a good bond alternative without the death benefit? I mean, I'd be curious to know his perspective. And that's a conversation for another day. And I'm sure in the comments, I would be curious, you guys, if you guys have thoughts on, would any of this stuff be good, right? Using a policy, borrowing against, having the policy, if there was no death benefit attached to it, would it still be a valid asset class to have? I'm curious what everybody thinks. But we only have 1 minute left, and so we are going to wrap this up. If you want to talk to somebody on the team about getting a life insurance policy, you want to talk to Demetrius, you want to talk to Austin, you want to talk to amazing individuals who care about you, who have a heart to serve, we are more than happy to do so. If anything, just a quick conversation to be able to ask questions, get to know a little bit about you is just where we want to be at. And so with that being said, everybody have an amazing day. Thanks again for spending the 45, 50 minutes taking to watch 3 guys just talk about life insurance. And till next time.
Yeah. Till next time.
You guys.
See ya.